So good morning once again. Today we're going to discuss what financial markets are, the institutions that are involved therein, and also the instruments. So this is quite theoretical, and it's also good for us to have an appreciation of what is involved in financial markets. Okay, so pardon me for the PowerPoint slides. It's quite a lot. So this is not the way to make a PowerPoint slide, but the objective here is more of an introduction. So what are financial markets? Okay, as the name suggests, it's a marketplace, okay, where financial instruments are traded. When we say traded, they are bought or sold. Okay, so buyers and sellers meet in the financial markets, and what is traded are assets such as stocks or equities, bonds. You have also currencies, trading of currencies, and what we mentioned before as derivatives. Okay, so that's a place, whether it's actual place or virtual place where buyers and sellers meet in order to trade assets. Okay, so it's a market should have transparent pricing. A characteristic of a market should have, if a financial market is to succeed, the pricing should be transparent. But when we say transparent, it means it's clearly defined. It means that whatever the costs in buying an asset plus any other incidental expenses must be clearly defined so that buyers will not be shocked or surprised of any hidden charges. Okay, so that's a very important attribute or characteristic of a financial market. And there should be regulations on trading, costs, and fees. Okay, so as I mentioned a while ago, transparent pricing. The price of the asset must be clearly shown. The costs in buying, any other fees, brokers' fees, stocks that are involved should also be made known. It should be clear. It should be, should we say, defined clearly by the regulations. Okay, so that's a well-established market. If this is present, then that's a well-established market. Nobody will be encouraged to trade in a market if there's no transparent pricing. Okay, and financial markets are very important. It's very central to the country's economy. It's the economy's central nervous system. Okay, so the financial markets, because it provides liquidity to the players, this is very important as regards the economy. And then information, market information must be made available to everyone. There should not be any party that is favored as regards market information. And market information should be quickly disseminated. Okay, because they are very important as far as the process of resource allocation and price determination is concerned. Okay, that's why this is very important, efficiency. That's why I remember I told you about the efficient market hypothesis. Okay, the characteristic of an efficient market hypothesis is that very transparent yung pricing. Guys, excuse me for a while. I'll just get water. Okay, sorry about that. The attendance, guys, later na lang. Okay, so we were talking about the efficient market hypothesis, and we said that it's very important for the market to be transparent. Otherwise, people will not be patronizing that market. They will not trade in the market. And the role of financial markets is that it offers liquidity. So we know that there are some parties that have need of cash, and there are some parties that have that want to trade their assets. So this is the place where buyers and sellers meet, okay, in order to communicate information and to share in the risks that are involved in trading of securities. So what are examples of financial markets? Later on, we're going to explain this in detail. You have money markets where if you want to trade in short-term funds, you go to the money market where the duration, the term is usually less than 1 year. Capital markets, these are for long-term funding. And then securities market, you have primary market, secondary market. These are just examples of financial markets. There are several other financial markets. Okay, so who are the principal players in the financial markets? You have borrowers, you have savers, and then you have the intermediary. Okay, so these are the three players in the financial markets, and this is very consistent with the definition of a market. It's a place or mechanism where buyers and sellers meet. Okay, so as I mentioned a while ago, a financial market allows the interaction between lenders and borrowers. There are those with excess cash, and if they want, and there are those that have need for cash. Okay, so in the marketplace, these two parties may meet. Okay, so a function of the financial market is to serve as a channel, okay, where funds can be transferred from either individuals or from firms. Okay. Sorry.
Sorry, sir.
Okay, and then also financial markets are very important as far as the economy of a nation is concerned. If financial markets are not functioning well, then that company can fail. You can see of many countries that collapse, especially many African countries collapse because of a poorly performing financial market. A poor financial market can easily lead to the collapse of a country. Okay, so there are two types of segments as far as financial markets is concerned: the direct and indirect. As the name suggests, for direct finance, the borrowers transact directly with the sellers. Okay, borrowers borrow directly from lenders in the financial market. So which means that these are, say, borrowers, and these are lenders, and the transaction is direct. Okay, there's no need for an intermediary. There's no need for a third party. Okay, so the lenders sell financial instruments or securities. Okay, and financial instruments or securities are claims on the borrower's future income or assets. So the lenders, okay, will be given what we call securities. So it's It's like a contract or a paper that tells, that specifies there that the borrowers owe the lenders a particular amount, okay, and that the lenders can collect on this amount. Okay, that's why it says here claims on the borrower's future income or assets. The lenders can claim on the borrower's future income or assets. Okay, then we have the indirect finance. What's indirect finance? For indirect finance, the borrowers and sellers don't transact directly. These are the borrowers, these are the lenders, and we have this intermediary. So intermediaries, okay, we have financial intermediaries. Example, banks. Okay, banks are a good examples of doing transactions indirectly. Okay, because the amount that banks lend to borrowers are not actually their money. What they do is there are savers. Okay, there are those that have extra cash and they put in their money in the bank, and the bank uses these funds in order to lend to borrowers. So this is an example of indirect finance. Borrowers borrowed indirectly from the lenders via financial intermediaries. Okay. And in the same manner, there are also financial instruments that are issued, okay, which are claims on the borrower's future income or assets. Okay, any questions so far, class, about the difference between direct and indirect finance? Please chat yes if our discussion so far is clear. Okay, waiting for the others' response. Okay, thank you. All right. So this is just an illustrative way to show the direct and indirect finance. So for the direct finance, you go straight to the any money market or capital markets. And so these are the borrowers. The borrowers can be firms, they can be households, they can even be the government or non-residents. And here are your lenders or net savers. Okay, and the funds are exchanged to the money market and the capital market. On the other hand, here is your indirect finance. So the lenders go through this financial intermediary, which then are linked to the borrowers or net spenders. Okay, so this is just a schematic diagram of how direct finance and indirect finance differs from each other. But the end goal is still that there are two or more parties: the borrowers, the savers, the lenders, and the borrowers. And in the case of indirect finance, there's this FI or financial intermediary. Okay, please don't mind. Sometimes because my stomach feels I'm having some stomach pain, and sometimes I react. So please just don't mind me. Okay. All right. So let's take a look at the financial system. These are the different markets. These are the savers, the suppliers of funds, and these are the borrowers. Okay, so let's take a look at this financial system. This is the direct way, and these are the intermediation. So this is your via indirect, and this is via the direct. All right. So how does this happen? You have savers, okay, or you have lenders. Okay, so the lenders can go to the equity market, okay, and they give cash, okay, which goes to the firms that issue the shares of stocks. Okay, so the firm gets cash and the firm issues shares of stocks, which the savers get. Okay, so take a look at the direction. Cash from the savers in the equity market. Okay, and then the firms get the cash and they issue shares of stocks in return, which is provided to the suppliers or the savers. Then also it can go to the corporate market, a corporate market or the bonds market, which are long-term borrowings. So suppliers can provide cash to firms in the form of cash, and then the firms will issue a security, okay, an instrument called the bond, and this bond is proof that this firm owes this saver, okay, this lender, a certain amount. So this security now becomes a claim on the assets or future earnings of the firm. Okay, so that's where we get the definition of claims on the borrower's future income or assets. Okay, and then we have the money market. So the money market is where short-term borrowing, less than 1 year, is transacted. Same thing, cash to the firms, and then the firms will give what we call a commercial paper. Okay, but if it's the government, a treasury bill. Okay, if it's the government that's borrowing, they will issue a treasury bill. So these shares of stocks, these bonds, these commercial papers are what we call financial securities. Okay, so they are AKA financial instruments, shares of stocks. Okay, which indicates that the one holding the shares of stock has a claim on the future earnings of the one issuing the stocks. Okay, also the bonds and also the commercial paper. Commercial paper are issued by companies. Okay, it's a borrowing for less than a year, the tenor which is less than 1 year. Okay, so clear so far, class, as far as this is concerned, the direct finance is concerned. Kindly chat please if the explanation was clear. Let me repeat it one more time. Okay, let me repeat it, guys, for the sake of those who were not able to get it. So this is what we call the financial system. Financial system or the financial market is very important. It's the nervous system of an economy, and it's where funds are traded or exchanged. There are some parties that have excess funds, so they will provide cash to companies, to other parties. If it's in the equity market, then the firm will provide shares of stocks as proof that the one holding the shares are part owners of the firm, and that the shares of stocks are actually claims on the assets also of the firm. Okay, it means that they can share in the dividends. Okay, and in case of liquidation, they have a claim on the assets of the firm. All right, then it can be bonds, which is a borrowing, long-term borrowing. So this firm issues the security called bonds. It means that it's a proof that this company owes the lender X amount, and this usually carries interest with it, and it has a definition of how many years the firm will pay the obligation. Okay, and then the money market, which we said are the money market instruments are less than a year, okay, instruments. If a firm borrows and the term is less than 1 year, they issue what we call CPs or commercial papers. If it's the government borrowing, then the government issues what we call a treasury bill, T-bills. If it's long term, then it should be treasury bonds. So it should fall under this one, or treasury notes. Okay, so that's the direct finance in the financial system. So kindly chat, please, if that's clear so far. Okay, thank you so much. Okay, and on the other hand, we have this indirect way. Okay, so there are several parties that can be involved in the indirect way. So we have here intermediation via institutional investors. And here, since banks play a very critical role, so we separate them here, intermediation via banks and other lending institutions. So there are companies like insurance companies, pension funds, investment funds, and venture capitalists. So what are their role? Okay, from those investing in insurance companies, pension funds, etc., what they do is invest this in these markets. Okay, so they invest it in the equity market, in the corporate market or bonds market, in the money market. Okay, and then these institutional investors hold on to the shares and to the bonds and to the market in money market instruments. So they're the ones that invest on behalf of the lenders. Okay, like pension funds, investment funds, mutual funds. Okay, and the savers would give them or would invest in them. Okay, and this institutional investors would invest in the equity market, corporate market, or money market, because sometimes it's really difficult for a investor or a saver to invest on his own in the equity market. He has to be very knowledgeable about these markets, and it's best for him to have a portfolio. So it's not good to invest only in one stock. So if you're to invest, you have to invest in a portfolio of stocks, which means you have to have different shares of stocks, different companies. So what others do, especially individuals, if they don't have the capacity to really learn about this, they would go to institutional investors. They would go to, let's say, mutual funds, and the mutual funds, based on their contribution and based on their option on what type of investment, the mutual fund will be the one to take care of their financing of their funds. Okay, so the institutional investors play a very important role. Okay, for example, in the future, you might want to invest in stocks, and it's quite a tricky thing to invest in stocks. Okay, you can only do this through brokers. Okay, but if you don't have the know-how, what you can do is go to a mutual fund or even a UITF, which is through the banks, Unit Investment Trust Fund. Put your money there, and the banks or the institutional investors will be the one to invest it in the equity market, the corporate market, or money market. Okay, so you don't have to, especially if you're afraid of doing it on your own. Okay, it would be good to do this through institutional investors. Okay, it's the same process. It's just like you putting your funds in another company instead of you going directly to the markets. Okay. All right. Any questions about the indirect finance? Okay, kindly chat please if so far very clear yung distinction. The distinction between direct finance. For direct finance, you go straight to the market. You are on your own. Okay. You are on your own. You deal with that directly. If it's indirect, you go through intermediation. Okay, is that clear, class? Kindly chat please if the explanation is clear. Okay, only 3. So let's wait for the others to respond. Unless you have questions, please. Right, thank you so much. Okay, so this is another way to put it. Class, we have this lender savers, we have this borrowers. So this is the direct finance. Okay, the funds go to the financial markets directly, equity market, debt market, capital markets, money market, which are direct. And this one, the funds go to intermediaries. Okay, so we said that the financial system, the financial markets is very important because it helps in the economy of the nation. It improves economic efficiency. Imagine if there are no markets and there are people with who have excess cash and they don't know what to do about it. They cannot. They have no opportunity to invest in it. And if there is no mechanism by which these people or these entities can hook up or can meet these entities, then we will not, the country will not gain economic efficiency. So you can see here the importance as far as the flow of funds is concerned, very, very critical as far as a country is concerned. Okay, so here let's just reinforce that point that financial markets are very critical to the economic well-being of a country. If you have excess cash, and if there are no financial markets, as I mentioned a while ago, then what are you going to do with this? Just let it stay there in your house and not do anything about it? If there is no market by which you can earn from this excess cash, then what are you going to do with that money? In the presence of a market, the net savers can put this in the market and make good productive use of it. And also there are some borrowers who can use these funds and then put it to good use. So both parties are benefited from the transaction where the borrowers and lenders meet, and they both benefit from the trade, from the transaction. Okay, and as we said, it's very critical for efficient allocation of capital, and it allows for funds to move from firms to firms, from people to people, from parties to parties. Okay, financial markets improve the well-being of consumers. allowing them to time to purchase, time their purchases better. Okay, so it's the importance of financial markets cannot be overemphasized. Okay, so here is just an explanation of the different types of market. Okay. First, we have, according to the type of financial instruments used, we have also whether the securities are new or old issues, or whether the market can be localized geographically or not. So these are just some examples of it. In the case of debt market, okay, if the borrowing is less than 1 year, so I said it's the money market. Okay, so mga debts to, no, mga borrowings. For short term, it's the money market. For long term, it's the capital market. For the money market, if it's the firm, if it's a company that's borrowing, okay, if it's a company that's borrowing, what the company issues is firm. What the company issues is what we call commercial paper. So these are like IOUs. IOU. It's a debt, no? And the duration of which is less than 1 year. Okay. If it's a government that's borrowing, then if it's less than 1 year, then it's treasury bills. If the maturity is more than 1 year, then we call the market capital markets. Okay, and you have here for companies, you have here bonds. Bonds. Or for the government, if it's more than 1 year, you have treasury bonds. Okay. So this is debt markets as to the type of financial instruments. Because as you know from your accounting, from your basic accounting equation, if you recall this, assets is equal to liabilities plus equity. So firms can raise assets, raise funding for their assets, either by borrowings or by infusion of capital from owners. So this is by debt, and this is by equity in the form of stocks. Okay, so companies can either issue bonds. When you say if a company issues bonds, it means it borrows money, or the company can issue shares of stocks. And the holder of these shares of stock is part owner of the company. All right. As to whether the securities are new or old issue. Okay, so first we have the primary market, and this refers to new security issues sold to initial borrowers. And in the stock market, if you're selling to the primary market, if a shares of stock is being, if a stock is being issued for the first time, then it's called your IPO, initial public offering. Okay. However, if the stock has already been bought or sold before, then you issue it in the secondary market. So shares of stock that is issued for the first time, it will be sold in the primary market. Shares of stock that has been previously issued, it will be sold in the secondary market. Okay, shares of stocks that are being issued for the first time will be sold, will be offered as what we call IPO, or initial public offering. All right. And then lastly, Of course, there are many other classifications, but let's just take a look at some of them. We don't need to really be look at the uh, let's say the whole spectrum of financial markets because there are so many. Okay, whether the market can be localized geographically or not. Okay, for example, exchanges. New York Stock Exchange. Okay, so these are conducted in central location, which means there's a physical place that trading is conducted. Okay, so when you say exchanges, these are physical places where the transaction is conducted, or on the other hand, you have OTC, you have over the counter. Okay, which means that there's no physical place, but there's a virtual place. Okay, you can buy or sell a stock even if you're in another place. Okay, so exchanges are for physical places, and OTC markets are for virtual. Okay, once again, guys, I'll pause and ask your feedback if these are clear so far. Okay, thank you. All right. Thank you so much for your responses. Okay, good. I see no questions, so let's proceed. Okay, as I said, class, there are so many types of markets. We just looked at, some of them. This one, we discussed them. Primary, secondary, money, capital market, bond market this time. Okay, we have also consumer credit markets, OTC market, spot market, I think we discussed before, where you can buy commodity at, on the day itself. Futures market, these are derivatives, if you recall, which we discussed before. And we also have foreign exchange markets. So many types of financial markets, and they differ in the product that's being sold or traded. Okay, so this is just to quickly review what we have discussed. We said that money markets are for short-term debt, okay, with a maturity of less than 1 year. Okay, this is here what's issued are financial instruments. When you say financial instruments, we mean these are securities. Okay, so these are issued by the borrower as proof that they have this debt. So this is for high liquidity. Very short maturities are traded. 30 days, 60 days, 90 days. So very short maturity. Okay, it's used by participants as a means for borrowing or lending and lending in the short term, from several days to just under a year. If companies issue or borrow in the money market, they issue what we call commercial papers. On the other hand, if it's a government that's borrowing, the government issues what we call treasury bills. Okay, for capital markets, these are, it can be debt or it can be equity. So capital markets can be of two types. It can be debt or it can be equity, such as stocks, equity, bonds, debt for medium and long term. So when we say capital market, okay, it can come in the form of debt, or it can come in the form of equity. So they're different from money markets because money markets have maturities that's less than 1 year. Here, the maturity can be 100 years. So before Disney company issued a bond. It's a debt instrument for 100 years. The maturity was 100 years. Okay, so clear about the distinction between money markets and capital markets. As I said, because capital markets can be debt. Okay, it can be equity. Okay, when it's debt, it's usually bonds. And of course, for equity, it's shares of stocks. Shares of stocks for equity. Okay, bonds here. And if it's the government, that's a borrowing, call it treasury bonds. Okay, so this is for medium and long term. While on the money markets, it's just not exceeding 1 year. Okay, so back to my question, class. Is clear so far? So far, is our discussion on money markets and capital markets clear? Okay, I'm sorry if I have to ask this question once in a while because I just want to check if you're understanding my explanation. Okay, thank you. Although we're not able to get 100% response. Okay. Okay, so money markets, capital markets. Okay, we said that capital markets can be of debt market or it can be equity markets. Okay, so another way to put it is securities markets. When you say securities markets, the company borrowing or the company acquiring cash from the other company issues what we call securities. So securities are instruments. These are financial instruments that show that a particular company is indebted or that the company issues this, like shares of stocks, as proof that the one holding that shares of stock is a part owner of the company. So it's a market for the following instruments, stocks or bonds. So this is related to your capital markets. So it just specifies it in a different way. Okay, so as securities market, it can be in the form of stocks. Okay, where the holder of the stocks has proved that he or she is a part owner of the company, and also bonds, so which establishes a creditor relationship with the corporation or the government. Okay, so as we said, just like the capital markets, the security markets are typically divided to debt, securities, and equities. Okay, so the securities market is related to your capital markets, and it's also related to your primary and secondary. If a particular stock is being issued for the first time, then it will be traded in the primary market. However, if that stock is being traded for, has already been issued before, then it will be traded in the secondary market. Okay, so I think this is just an amplification of what we have discussed so far. Then this is the primary market and the secondary market. So these are new security issues sold to initial borrowers. Okay, and usually the company that issues these new shares of stocks will hire the services of an investment bank. Okay, investment bank. Okay, because the company who will issue the shares of stocks might not be capable of doing that. So there are companies that have that expertise. That's what they do. They help the companies issue the shares of stocks, and they're the ones that sell the shares of stocks in the primary market here. However, in the secondary market, we said that this has already been issued or bought previously. So for example, okay, if I'm going to sell my Jollibee shares, I'm going to sell it in the secondary market, not in the primary market. Because Jollibee shares have been bought or sold several times already. So I can go to the Philippine Stock Exchange. Okay, by the way, what's the meaning of FTSE, DAX, NYSE, and NASDAQ? So I'll give you a few minutes, guys. What's FTSE? What is DAX, DAX? What is NYSE? What is NASDAQ? Okay, let me wait for your answer. What's FTSE? Okay. Thank you, Martina, Schuyler. Yeah, what's the meaning of NASDAQ, Schuyler? So the FTSE is Financial Times Stock Exchange. So this is the stock exchange of what country? Martina, the FTSE is the stock exchange of which country? And how about the DAX? Yeah, correct. FTSE is UK. Schuyler, what's the meaning of NASDAQ? National Automated. Please share your answers to everyone, please. Okay, let's start first with FTSE. So FTSE is the what? FTSE is the stock exchange of, okay, thank you. Okay, so we have here Diana, sabi dito, British financial organization specializing in provide index offerings. Okay, so FTSE is the stock exchange of UK. Okay, so in the Philippines, we have PSE, okay, Philippine Stock Exchange. So each country has its own stock exchange. Okay, so UK has Financial Times Stock Exchange. What's DAX? DAX is the stock exchange of what? Class? Okay, Deutscher Aktien Germany. No? So this is the stock exchange of Germany from DAX. No? How about itong Kakorong? This is also the index. So saan yan, guys? CAC 40. Okay, that's French. Okay, and so we have the different stock exchanges of different countries. Huh? Okay, NYSE is New York Stock Exchange. Okay, this is an exchange. No? NASDAQ is an OTC. Okay, I think I saw in the chat the meaning of NASDAQ. Yeah, thank you. It's National Automated Securities Dealers Automated Quotation. Okay, and what's the difference between Yeah. Thank you, Fiona. You call it cocarant, cotation, assisté, and continue. This is French. Okay, so each country has its own stock exchange, at least the ones with a stock exchange. And anong difference ng NYSE at saka Nasdaq in terms of what we have discussed so far? Yes, in terms of classification. Can somebody please? What's the difference between both are in the States, in the US? NYSE is what type of market? And Nasdaq is what type of market? Will you kindly check? Okay, yes, different types of companies, yes, in both, no? Okay, Nasdaq is a dealer's market, volatile versus stable. Okay, yeah, okay, partly true. Nasdaq is a dealer's market, NYSE is an auction market. Not necessarily, pareho naman silang dealer's market. No? Ang difference, guys, NYSE is an exchange. Physical location to. Nasdaq does not have a physical location. Okay. Well, in a sense, auction market. Nasdaq, guys, is OTC, over the counter. All right? OTC siya. Okay, clear yon, class? NYSE is an exchange. Nasdaq is OTC. Now, my question is, how about PSE, Philippine Stock Exchange? Is it still an exchange? Is there a physical location to it? PSE, could you kindly check, class? The Philippine Stock Exchange. Waiting for your answer, class. Is the Philippine Stock Exchange a physical exchange? Kindly check, please. Any answer, guys? Kindly check in the net. What happened to Philippine Stock Exchange? Okay. Okay, thank you, Diana. But did you check the internet now? So what's the most recent news about PSE? Waiting for your answers, guys. It's going down. Uh, all right. June 10 pa yan, no? Yung most current one. Yeah, so it's going digital. It means OTC na siya. No? Virtual na, yes. Thank you. So before, there used to be yung may physical place, no? Yung Philippine Stock Exchange. Okay, people would go there to trade through their brokers, but now it's already closed. So no more physical trading there. So Philippine Stock Exchange. Okay, can you present the most current one? Fiona presented here June 27. Let's present a more recent news. Okay, could you provide a link? All right, thank you, Christine. What does that say, Christine? Can you summarize to us what that news article tells us? Christine? Okay, Christine gave us a URL. Okay, so let me. Okay, let's see what Christine shared to us. Is this the same as the one shared by Fiona? I'm not getting it. No? Anyway, so what's the latest about the Philippine Stock Exchange class? So it's already what? It's already virtual, okay? It's already an OTC, over the counter na siya. No? Okay. All right. Now, just some notes about the secondary market. Okay, in the primary market, the company that issues shares is the one that gets the cash. However, in the secondary market, okay, for example, if I bought Globe shares of stocks in the Philippine Stock Exchange and then I sell it, Globe does not get the money. Okay, if I sell my shares of stock in Globe and somebody buys it, okay, through the market, through the Philippine Stock Exchange, it's not Globe that gets the money. So what benefit does Globe get from the global market? If Globe issues the stock for the first time, it will be traded in the primary market and then they'll get the cash. Of course, they have to pay the investment bank for doing that process for them. So take note of this. Even though firms don't get any money per se from the secondary market, it has two purposes. Number one, it provides liquidity, making it easy to buy and sell the securities of the companies. And it's also useful for determining what's the market value of the company itself and the market value of the shares of stocks. If that company's stocks is being traded, for example, there are many buyers, what will happen to the price of that stock? It will go up. Okay, it will go up because consistent with the law of supply and demand. If many people would want to buy that shares of stocks, then that's indicative of something. What's the motivation for people to buy that? maybe there's something in the performance of the firm that makes it attractive for investors to buy the shares of stocks. Okay, so the demand for the shares of stocks in the secondary market is also an indicator of the performance of the firm, and it's also a driver. It's also a driver of the price of the stock, and it's also a indicator of how the firm is performing. Okay, that's why we say here that aside from providing liquidity to those who would like to buy and sell, as far as the firm is concerned, it establishes a price for the security. So very important for the shareholders, because shareholders, as we noted before, would want that aside from the dividends, more important for shareholders is the capital appreciation. Okay. All right. Let me pause again for a while. Any questions about the importance of the secondary market, even if the company does not necessarily get the cash from the transactions in the secondary market? The company will get the cash in the primary market, but not the secondary market. Okay, is that clear, class? Kindly chat, please, if the explanation is clear. Okay, good. Thank you. Thank you so much. Okay, so this is again just a summary of another form of our financial markets. We have already defined this, but I'm just summarizing this about securities market. We said that securities market are related to capital markets and even primary or secondary markets. And as defined before, a security is a written legal obligation of one party to transfer something of value, usually money, or in the form of certificate of ownership that can be traded to another party at some future date under specified conditions. Okay, so if you bought a shares of stock, for example, from from say PLDT, before there was a document, there was a security, okay, there was a paper that will be given by PLDT, okay, before, no? And then if you have that shares of stocks, then you can trade that in the stock market. You can sell that shares of stock. Okay, but now there are no more papers given, so it's more of a database, and in that database, Philippine Stock Exchange records who the owner of that shares of stock is. So whether it's on paper or whether it's recorded in the Philippine Stock Exchange, you can sell that shares of stocks. Okay, you can sell that certificate of ownership because PSE has that record. Okay, and then through the broker, you can sell it to another party, to a would-be buyer. Okay, so the securities now is quite different from the securities before. The securities before were shown via paper. So it's now scriptless, no more paper, but the mechanism itself, the stock exchange, provides that ownership. Okay. All right. So the function of this, the securities market, is price discovery. What really is the price of that shares of stocks? Liquidity, and then also reduced transaction costs. And then, as we said, it can be stocks, bonds, okay, or other types. All right. Then taking a look at intermediaries, which I already discussed a while ago, these are corporations that provide services as intermediaries of financial markets. Okay. Okay. All right. The function of intermediaries is they can intermediate as far as the maturity is concerned, and they can also reduce the risk. If you're an investor and you would want to invest in the equities market, so you will have to buy several shares of stocks of several companies, because it would be risky just for you to invest in one type of stock. Okay, so what you can do is go to the intermediary like a mutual fund, and then there you'll be able to invest in several stocks, okay, through the intermediary. Okay, so you're able to reduce your risk and you reduce your cost, because it's very expensive if you'll be the one to buy. For example, if you want to have a portfolio of 20 different stocks, that will be very expensive for you. But if you tap the services of a financial intermediary, it would be lesser cost for you, because mutual funds, for example, what they do is to pool the resources of several investors, okay, and then they transact as one. Okay, that's why it's and there are mutual fund managers that handle the account. Okay, so it's less costly for the individual investors. Okay, so examples of financial intermediaries are, you have depository institutions like banks, insurance companies, investment companies, and investment banks. Okay, each of them have different roles to play as far as financial intermediaries is concerned. Okay, so this is, to put it in another way, the role of indirect finance, which is the financial intermediaries, instead of the savers, okay, going directly to the borrowers, the financial intermediary, okay, plays as the middleman. Because, for example, it might be difficult to find a lender. Okay, so banks play as a middleman. They gather together the lenders, pull the money, and then lend it to borrowers. Intermediary obtains funds from the savers, and then the intermediary makes loans or investments with the borrowers. So that's intermediary, or that's our indirect finance. Okay, as stated, this is called financial intermediation. Okay, and it's actually the primary means of moving funds from lenders to borrowers. So these are more important source of finance than securities market. So yung financial intermediation, these are more important sources of funds to borrowers compared to securities markets such as stocks. So in an intermediation, the transaction costs are reduced. Okay, there's a lower risk. Okay, and there's what we call asymmetric information. What's asymmetric information? So banks, for example, as financial intermediaries, have more information compared to, let's say, borrowers. So banks has transacts business with several savers. Banks has much more information than a single borrower. So there's what we call asymmetric information. And because of this asymmetric information, the borrower will tend to benefit by that, because the bank has certain information that they do not know, and then they will benefit from that information. Otherwise, they might need to research. Otherwise, they might need to research on that or buy that information that's already available with financial intermediaries. Okay, so this is very important. Transaction, why will borrowers go to financial intermediaries? There's a lot of advantage in doing that. Transaction cost goes down, risk is mitigated, and that the presence of asymmetric information benefits the borrowers because they can tap the information which the financial intermediaries have, which they do not have. Okay, on the other hand, financial institutions make profits by reducing transaction costs by developing expertise and taking advantage of economies of scale. What does that mean? So if they have a large volume of transaction because they pool the resources of the investors, they're able to lower down financial costs. Okay, kasi volume na to eh. They're already basing it on volume and they will enjoy economies of scales. When you say economies of scales, the variable costs goes down as the level of output increases. Okay, so since the intermediaries, like for example, which I mentioned to you, mutual funds, okay, because they're able to pool resources, they have millions on their portfolio because several individuals and firms would invest in them. And then when they're the ones that invest in the money market, in the capital market, in the debt market, they're able to conduct their business at lower cost and then at less risk. And because they have their expertise, they have been doing that for some time. As compared to if I was the only one, and then I'll go to the equity market, I might be lost and I might make wrong moves. Okay. All right. So I hope that's clear, guys. I hope you can see the importance of indirect finance, which really has a very, very important role, and which really, for me, it outweighs the role of direct finance. So what do we mean by if the FI's low transaction cost? What do we mean by, what's the implication? They can provide its customers with liquidity services. Okay, so it's easier for customers to conduct transactions. They will be able to provide lower transaction costs for the customers, and the customers will be exposed to lower risk. Okay, in the case of banks, banks provide the depositors with checking accounts that enable them to pay their bills easily. So banks can provide services to the depositors, okay, which they could not get if they did not tap the services of the banks. Also, the banks, the depositors, even if it's small, they can earn interest. Okay, although I said before that you should not put your excess cash in the bank. What you should put in the bank are just your emergency funds. For example, for how many months you can put it there. But for the others, those that you're not going to use in the next year, next 2 years, better put it in a mutual fund. Okay, or in the banks we have what we call the UITFs. Okay, so UITFs. So this is Unit Investment Trust Fund. These are like mutual funds, okay? Mutual funds. The difference between this is mutual funds are done by private companies, while UITFs are done by banks. Okay, but the concept is the same. What mutual funds and UITFs do is that they pool resources, the investments coming from their investors, and then they'll be the ones to invest that in the money market, in the capital market, in the debt market. Okay, for example, in some banks, the minimum investment is just 5,000. Okay, so invest it in 5,000 in a UITF, then it's as if you're already invested in different shares of stocks. Okay, so that's what the a very important role of intermediaries. Okay, another important benefit by financial institutions, low transaction cost. So low transaction cost benefits your depositors or the investors, and also it mitigates against the risk called risk sharing. Okay, so since marami yan, okay, there's a pooling of resources, so the risk is shared across several investors. So financial intermediaries create and sell assets with lesser risk to one party in order to buy assets with greater risk from another party. Okay, and that's called asset transformation, because in a sense, risky assets are turned into safer assets for investors. Okay, so the financial intermediaries are able to transform the asset from one with a high risk to one with a lower risk. Actually, this is very interesting, no? Very interesting tong role ng financial intermediaries. Okay, and they can also diversify asset holdings. Okay, let me check the time. I might have gone. Wait, huh? So it's almost time, guys. So all right. So what I have left are just a few slides. Okay. All right. I'm going to post this. Okay. The other slides, guys, I already discussed. Commercial banks lang siya. So these are just the functions of just continuing the functions of financial intermediaries. So commercial banks, you know the role of commercial banks. They get in depositors. They are financial intermediaries. Also investment banks. They help companies raise capital. They're also called underwriters. So if a company, for example, needs 10 billion, okay, normally they will tap investment banks, and investment banks will help them raise that 10 million. Investment banks would underwrite for them. They would tap several banks and get what we call a syndicated loan. Okay, yung syndicated loan, they would tap several banks because a bank may not be able to raise that much amount of funds. So they will tap, let's say, 3 banks or 4 banks or 5 banks. And these 5 banks will be the ones to pull the resources to raise the 10 billion alone. And that's done by the investment bank. So they're the ones that will underwrite. They will write the contract, okay, on behalf of the borrower, the firm. Okay, so these are just functions of investment banks. Okay, they help corporations come up with securities so that they can borrow funds and that it can be attractive to investors. Now, sometimes the investment banks will buy the securities themselves for the corporation. Okay, they will buy the securities themselves from the corporation, and they will be the ones to sell the securities. All right, and then so here are some role of investment banking in the Philippines. And last 2 slides, guys, examples of top investment banks in the Philippines. Okay, so these are separate from the banks. For example, BPI. BPI is different from BPI Capital Corporation. This is the investment bank of BPI Corporation, so it's different. So Metro Bank has First Metro Investment Corporation. Okay, PNB has PNB Capital and Investment Corporation. So the banks have diversified. They have created their own investment banks because investment banks have a different services. Okay, and lastly, we have financial services corporations. These are large conglomerates, and they combine the different financial intermediaries into a single corporation. For example, Citigroup. Citigroup is one big conglomerate that houses the different commercial banks. Okay, meron silang Smith Barney investment bank yon. They have insurance companies all into one. It's called Citigroup. And that's what we call a financial services corporation. All right. So thank you so much, class, for your patience. That ends our discussion for this one. So that ends our discussion for the financial markets, financial institutions. Okay, I'll post this later. Okay, I hope you do some research on mutual funds and UITFs because that might be a good investment scheme for you at the onset. Okay. All right. So let me stop recording now. I hope you learned something. Okay. Could you kindly chat, please, guys? If you learned something today, if